Hey everybody, welcome back. This is Ryan and welcome to the Investing Channel. In today's video, I want to talk to you guys about futures and options and why you may want to stay clear of them. But before we get started, if you guys are into investing, whether it's stocks, bonds, mutual funds, whatever type it is, real estate, please look over on the right side of your screen, right over here, and subscribe to the channel. And also, when that notification bell pops up, please punch it with your mouse so that you're notified the next time I come up with a video on investing. Okay, so let's get started. Let's say, for example, you've been monitoring a certain company for a while. You feel it would be a good investment, and you're thinking about maybe buying some shares of stock for that company. Could be Apple, could be IBM, could be any company out there. But whatever a company it is, let's just say that you're interested in its products and its service and you think that it does a great job. Okay guys, so let's say for example you go out and you purchase some shares of stock for that company, and right now that stock is trading at, let's say, $100 per share. And over the course of the year that stock raises, it goes up to $150 per share. So that's great. You've made $50 profit on each share of stock off your initial investment, which is great. That's what we all hope for. We hope that any time we purchase stock, the values are going to go up, right? But now let's say instead of buying the stock, you buy what's called options for the company. Okay, so this is called a call option. What it is basically it's an option to purchase shares under specific terms that is going to be from the person who is selling you the option to begin with. And let me explain more. So you may be able to purchase an option that allows you and gives you the ability to purchase a stock in the future at a specific price. But if that happens, you're going to end up paying a call fee, okay? So you may be able to purchase a call option to purchase a stock at a later time at a specific price. So let's say, for example, you want to purchase it at $130 a share. Well, you may be able to purchase that call option, but to have that right, you may end up having to pay like $2 or $3 per share. Okay, so it gives you a future right to be able to purchase a stock at a specific price, but to be able to have that option, you have to pay a fee for that, okay? That's called a call option. Okay, so let's throw out another scenario here. It's going to be a little bit complicated, but just follow with me, okay? So let's say, for example, the stock that you're interested in is $100 a share, all right? So you could purchase the stock right now for $100 a share, but instead of doing that, you do a call option on the stock at $120 a share. And the cost to do that call option is $2 a share. And that gives you the ability to purchase a stock at $120 a share. So let's say you have that call option, it's sitting out there, and then over the course of the next 10 months, the price of the stock goes up to $150 a share. For everyone else, the cost is $150 a share, but for you, because you did the call option, you can pick it up for $120, right? That's a $30 difference, okay? So you're able to get that stock at a $30 difference from what the average person is able to do. Now, the cost for you to be able to do that was $2, $3 a share. So it didn't cost you that much, but now you're sitting in a good spot because you can purchase stock out there that's worth $150 a share, and you're able to pick it up for $120. So you do have the ability of selling that call option and basically making like 15 times the amount of money that it cost you to purchase the call option, the $2, right? So it's a $30 difference. So let's continue more about options and futures. Okay, so let's talk about something else with regards to that. So you purchased a call option. You spent, $2-3 to have that call option to be able to purchase that stock at $120. Over the course of the next 8-10 months, the value of the stock only goes up to 120, right? It's at 100 now, but in the next 8 to 10 months, whenever that call option is going to be expiring, then the value is basically right where you could purchase it at anyway. So you're basically breaking even. So you're not making any money on it. That's one scenario that could happen to you. So the next negative thing that could happen, and the thing that you may want to stay away from futures and options, is that in the scenario, you purchased the call option for $2 to $3. You purchased it for an expected price of $120 a share, and you're just kind of waiting for that short-term gamble. You're hoping that that stock's going to raise up above 120, right? You're hoping that it's going to get to $150, $200 per share. But what could happen is the market could start going down. The stock of the company could start dropping even lower than 120. It could drop even lower than 100. So it's kind of a gamble there. If the value of the stock or even the market starts to change, everything could drop, and your call option's basically worthless. So it's a short-term gamble, guys, and that's one of the things that you want to think about when you're getting into options and futures. Now, futures are going to be similar to options in that they're both kind of a gambling tool, a gambling instrument that is dealing with stocks, okay? So let me explain more about futures. So futures are going to be dealing more with commodities like oil, gold, pork bellies, wheat, things of that sort, okay? Futures have a specific delivery date that's not going to be too far in the future. So you could place a small down payment, roughly 10% towards the purchase of futures, which is going to greatly leverage your investment. But the thing is, if the price falls on your investment, then you're going to have to throw more money into it to make sure that you don't lose your position and having your position sold. So really the only use you may have for these is to hedge. So let's say that you own a lot of stock. It's valued greatly over the last year or so, but you don't want to sell because you're worried about taxes on that. And let's just say that you don't want to sell because maybe next year you have other plans. Or maybe there's a capital gains benefit for you in the following year. Maybe you're going to hold off for another year before you sell. If that's the case, then what you can do is you can purchase what's called a put option, P-U-T option, which increases in value when a stock's price falls. So a put option gives you the right to sell your stock to a purchaser of the put option at the present stock price. So if the stock price goes down, the rising put option offsets some of your losses on the stock that you still hold. So in conclusion, using a put option helps you postpone the selling of your stock without exposing yourself to stocks that are dropping in value. So that's it, guys, for this video. Thanks for watching. I know it's a little bit complicated. I'm going to be having more videos on investing. So if you're interested in investing again, please look over here on the right side of the screen, subscribe to the channel, also smack the notification bell when it pops up. That way you'll be notified when I come up with more videos about investing. All right, thanks guys for watching, and I look forward to seeing you guys in my next video. And also, by the way, I do have other videos, so please go check them out, okay? Thanks, bye.